I'd like to take a moment to talk about the mortgage market. Now, the mortgage market is something that people know something about because most people get mortgages when they buy their first home or maybe even their first apartment or co-op. And when you borrow money to buy a mortgage, that's normal because, of course, hardly anybody has the money they need to buy a house. When they're a young person, they need a house. And so it makes sense to borrow money now and pay it back later. Well, and meanwhile, you get to live in a house and raise a family and whatnot. So that's all good. The problem is that in the old days, mortgages were actually part of business that were done by savings and loans. In fact, you remember, if you're old enough, you'll remember this SNL. There used to be there was an SNL crisis in the mid '80s, and savings and loans were in the business of taking in deposits from depository institutions, and they on-lent that money in the form of mortgages. And so they could basically borrow money, say in deposits, and they might borrow money at, say, 3% on their deposits, and they would lend it out at maybe 5% for a mortgage. So they made 2%, and that was good business for them. And the problem is they were borrowing money at 3% kind of on an overnight deposit basis, and they were lending money at 5% on a 30-year fixed-rate mortgage. So that in the late 80s, early 80s rather, when interest rates went to, well, gosh, interest rates got to as high as about 21%, short term. When they got to 31% short term, banks found themselves borrowing money at 21%, no longer at 3%, but they were still committed to have that loan at 5%. So they were paying out 21% and earning 5%. Of course, they were losing money, and of course, what was happening is they were really bankrupt or going bankrupt. And that's what happened to the S&Ls. So that mortgage market transformed. S&Ls couldn't be the place that held on to those mortgages anymore, and we needed to find another way that we could distribute those mortgages. There's another problem with those mortgages, and that was they were individual, banks were local, or at least were local. Now, as local banks, a banker is in the business, a bank officer, bank manager is in the business of making loans to their local community. So if you wanted a home, you go to your local bank, you sit down at the desk, you look at the loan officer in the eye, and you say, "Mr. Loan Officer, I'd like a loan so I can buy a house." And he looks you back, and he says, "Well, tell me about yourself." And he knows you, and he knows the community, he knows where you work, he maybe knows your boss. And that bank officer was also on the hook, because that loan that he made to you, if you basically didn't pay it back, it was his neck that got cut as a loan officer. So that loan officer on the other side only wanted to loan money to people he was pretty darn sure were going to pay that money back. And as a result, he probably didn't make loans to some people that otherwise deserved them. And back in the old days, there were probably too few mortgages. But again, that problem was one that had to get addressed by capital markets. So they invented a new thing, which were called mortgage pools. And in a mortgage pool, you have a large number of banks from a large number of different communities, each making mortgages. So you have a bank in Boston making mortgages, and one in New York making mortgages, and one in Detroit, right? And one in Kansas City. And all over the country, different cities, different banks are making mortgages. And they put those all together, so each one kind of makes 10 mortgages, if you will, and maybe there's 100 different cities, each of which a loan officer makes 10 mortgages. So you'll end up taking 1,000 mortgages and putting them together from different cities. Those 1,000 mortgages then get put into one pool, and everybody takes back a slice of the pool. So the bank in Boston, instead of owning 10 Boston mortgages, owns a slice, maybe 1%, of 1,000 mortgages from 100 cities, as do all these other banks. So what that means, now of course the good news is that if there's a problem, so let's say Detroit, there's big problems in the auto plants and there's layoffs, right? That might have wiped out the bank in Detroit, but now the bank in Detroit has shared that risk with all those other banks. And it represents only a small part of their losses. So by sharing those losses in a mortgage pool, that became a very efficient way to manage the risk. And the main entities that bought those pools, created and structured those pools, were what known as government-sponsored enterprises, the first of which was known as Ginnie Mae, but the two big ones were Fannie Mae and Freddie Mac. And Fannie and Freddie basically both construct those pools and also bought large parts of those pools, but the banks also bought some of those pools back for themselves as investments. And that was a great way to create large diversified risks, replacing some of this S&L problem and also replacing some of this local bank problems. Okay, so that's the good news. We've talked about pools, and now we're gonna sort of move on here.